Cool. All right, good afternoon, ladies and gentlemen. My name is Adrian Cartland. I'm the principal of Cartland Law, a firm that specializes in tax and commercial law. And today we're going to be going through all of the fund land tax changes that we and our clients are going to begin to know and love if it gets through Parliament. So there could be a light at the end of the tunnel. This could all fall over. But from my understanding, it looks like it's coming in. So let's just start with an overview. This is what I'm going to talk about today. So at the moment, we're taxed under a system of looking at titles and creating ownership of properties. So we have the various provisions that will create a notional ownership. So say two people who own property together creates an ownership. A trust will be a separate ownership number. And it works by that. It will work by the separate company, a different person. They're assessed as the owner, and then the trusts, for example, there are various rules in section 13A that aggregate them. For example, if their beneficiaries aren't sufficiently different, or if they have a similar trustee, they're for the same beneficiary, whatever that means. Looks like all that's going out the window. As a 30-second overarch of where we're going, it's supposed to drill down the ownership of properties into individuals. So theoretically, these new rules are supposed to say, doesn't matter what entity it's in, is it a company or it's in a trust or whatever, we're going to drill down the ownership percentages, find some individual people and say you own this amount of land and aggregate it all together. Doesn't quite work like that, but that's what it's supposed to do. One of the reasons why it doesn't quite work like that is that it's actually a multi-tier layer of taxation. So you get taxed at the trust level, or perhaps various trust levels, and then there's rebates or credits at lower levels. But it's intended to have the effect as if you find a number of people and you say, this is your property, and so it looks through them. Now, of course, you don't need to look through into properties. You can, in certain circumstances, you can either elect or just by failure have there no look through of the ownership of properties. But in which case there will be a trust surcharge. So there's some sticks and carrots. Rather, actually, there's just a lot of sticks. So I'm just going to start off with an overview of the current rates for 2019-2020. And you can see here that it starts at 391,000 tax-free threshold, and then continues up to the highest rate of 3.7%, the highest rate in the country, bless them. The threshold here, when you get to 3.7%, is 1.3 million, so it's a nice low threshold. So you quickly get up to that high amount. And for that reason, people have tried to disaggregate properties, separate them out. It's essentially like if you put a dam in the middle of a big river. The river's not going to stop, it's going to try and work out a way around it. And if you've poorly designed something, people work out a way of making things work. And so now they're trying to build up the dam so the whole river stops.
Yeah, politicians put the law in, though. They put it in the Land Tax Act, though, didn't they?
Exactly, yeah. It's
So-
like, yeah.
The exemption.
So, and the best part is it's not a full rewrite either. Now these slides are going to be emailed out to you afterwards, but please take photos, and if you do have questions, I'm more than happy to answer impromptu questions. So now this is the possible new rates for 2021. We don't quite know. We have like a couple of figures in there, but this is a reasonable guess, but please don't hold me to it. And so here, for a standard rate, so for not a trust, $450,000 threshold, then the next threshold is to 755, where you're paying 0.5% tax, then 755 to 1.098 million, 1.65% tax, and then above that, 2.4% tax. So, and then of course, so there's the base amount, which is say at 1.98 million, you're going to pay $7,184 plus 2.4% on the amount above that. So this is just a calculation of the tax up to that number. So that's the easiest way of calculating marginal thresholds. So so it is lower, and you might think that this is nicely designed to help the big end of town. Because I mean, if you own a $100 million shopping center, like, you're probably winning out of this. And here's the trust rate. It's the same rate as the other one, except that above $25,000. I'm not sure why $25,000. It's a really small nominal number. You're paying 0.5% tax. So it's 0.5% higher up until you get to 1.98. And so at 1.098 million, you're paying $12,000 tax rather than $7,000. So you can see the impact of it. Obviously, at say $450,000, you're paying instead of paying 0, you're paying 2,250. So you look, for those those mom and dad investors who have a couple of properties, they're currently paying nil or a small amount. It's like that's where it's the real kicker. Okay, so here's how this is going to be implemented. The existing aggregation rules are going to be repealed. So all your 13A, 13.3B, the minor interest sections are going to be repealed, except for residential land. So technically, at present, if someone is buying property in a trust and they're concerned that this legislation might not go through, you have to pay attention to that. So if you are setting up a discretionary trust to purchase some property, which you can do until this legislation is introduced into Parliament, as it's written at the moment, then you must make sure that the beneficiaries of them are slightly different. Otherwise, it'll be aggregated with other properties. Once this is introduced, you can it doesn't really matter what the discretionary trusts look like. They can just be the same. They have the same trustee. All of those aggregation provisions are removed, except in the case of your principal place of residence. I'll come to that shortly. Now, where land is jointly held, it's going to be jointly assessed. It's a two-tier process. So husband and wife own an investment property together. It's assessed at them together. And then their proportional interest will be separately assessed. And it will be aggregated against other properties that they have. And then they get a rebate or a credit for the amount that was paid at the joint level. Why? Just to make things really confusing. Practically, this means that it's as if you've divided the property and said you each own 50%. You're owning 50%. Your 50% will be aggregated with any other property that you own. That's how it is intended to work, and should work in most instances. There will be a number of edge cases where that won't work. And one of the fun pieces about the edge cases is that if the amount that you would be credited is you can't get a refund out. So if you're going to be credited an amount that's more than the tax that was paid at the joint level, you can't get more back. So there will definitely be some fun edge cases there.
to carry forward?
I don't think it does. I don't think so. Yeah, it's lost. Yeah, and that's the way they've built it. And there might be multiple tiers. So when we look at trusts, it might be trust then it has a sub-trust, and a sub-trust below that might be 5 tiers. Could be a real pain. And then if there's a mismatch somewhere in that level, then tough luck. No rebates. No rebates to get a refund. So now community titles, they're going to be they're taxed on the lowest individual plan. So if you've got primary or secondary or tertiary, primary is the lowest one. That's the level it gets taxed. If there's secondary ones, that gets taxed, but not primary. Tertiary, if it's tertiary, that gets taxed, but not secondary primary. And there's no tax on common strata property. Now for trusts, it says that there is a separate assessment for the trustee. So it's treated as a separate entity. We don't look at the existing Section 13A provisions that ignore a trustee in certain circumstances. It says no, if you're a trustee, you're assessed separately and you're prima facie liable for it. And then it has a really nice broad definition of what constitutes a trustee. It includes an executor or a guardian or liquidator, or a person having possession, administration, or control of land, income, or property. So that could be someone managing property on behalf of someone else. That could be someone with some with a power, or some kind of contractual power over the property. They could be deemed to be a trustee, and then we'll see later of all of the obligations that fall upon a person who is a trustee, besides being liable for the tax. They also are liable to make a whole number of notifications repeatedly. So this is a lot broader than what we might ordinarily think of as a trustee. Now for fixed trusts and unit trusts, I've had a few people ask, what constitutes a fixed trust? Well, first of all, a fixed trust is not a thing at law. There's not a legal definition for a fixed trust, a unit trust, a discretionary trust. There are, however, certain situations where that will be considered. So there might be like some superannuation legislation that says this is what a fixed trust is, and then we look at Colonial Mutual, the decision. Or in here, there is like say in New South Wales, they have a specific legislative definition in their land tax of what constitutes a fixed trust, which is horrible and horrendous. And then there are other definitions of unit trusts. We don't quite know. All it says in this legislation is that, as it's written at the moment, is that it's not an excluded trust, which is your charitable trusts, your and some others. I've got the later slide, or a discretionary trust. Now, what constitutes a discretionary trust is quite broad. And a unit trust, it says that it's a unit trust. Now, it's not clear to me, the way it's drafted, whether a unit trust must be a fixed trust. So in New South Wales, they want a unit trust, it must be a fixed unit trust. If it's not, so if we don't have to have a fixed unit trust, we could have an ordinary commercial unit trust, then this is something we could actually work with in terms of structuring. Now, what I mean is what constitutes a fixed trust. So a fixed trust, the beneficiaries are going to be absolutely entitled to the income and capital. There might be no provisions for issuing further units. There are going to be no, perhaps, restrictions on altering the deed. Like it's going to be a bare trust, but even bare trusts are not fixed, say, for New South Wales definitions. So if we can have a unit trust deed where there is the ability of the trustee to accumulate income or capital, which they might choose to do, which is in your vanilla unit trust deed, or issue new units or different classes of units. These things might make it a non-fixed trust for, say, New South Wales. It's not clear what happens here. It might be the case that we can just pick. And so we can say, I think that this is a unit trust, therefore I'm going to nominate it as a unit trust, and therefore it's not looked behind. This is one of my big concerns when I go, how do we practically deal with this junk that we have to face? And having a unit trust that has some discretions in there is something that we can make things better with. What my fear is the way the legislation is drafted at the moment. You could probably, be comfortable using a unit trust that's not fixed, with some discretions or some abilities in there. But my fear is that in a couple of years' time, Revenue SA will say, no, we're just going to take a different view. We're going to say, no, it's got to be something that's, fixed like New South Wales. And there's quite a lot of case law in New South Wales that is quite antagonistic to taxpayers. So if you have a fixed or unit trust, you can make a nomination of who the beneficiaries are. If you don't, you'll be taxed at the higher tax rate, at the trust rate. And again, you're going to be taxed at the trustee level, as if this is the only land held by the trustee, so on the marginal tax rates, and then the beneficiaries will be assessed on their proportion. So at that rate, at that time, it'll be aggregated with the other land held by the beneficiaries. Again, there's no refund on the credit of the proportion of tax paid by the trustee. So now with discretionary trusts.
Sorry, just going back to that one there. So you nominate a beneficiary.
Well, no, so you need to give notice of who the beneficiaries are under that unit trust. So if you have a unit trust and you have John and Maria as the two unit holders that each hold 50%, you need to tell the Commissioner, Revenue SA, who are the unit holders. And so in which case they will be assessed themselves on that 50% ownership each. So you can't just nominate anyone. You have to nominate who are the unit holders. And if it's a fixed trust, which it seems to me it means that it's a trust that can't be altered and that can't be changed, and you say these are the people who are the fixed beneficiaries of the trust. So
back to a joint ownership.
Yeah, the idea is like what they're trying to do is cut through everything and say, no, imagine that it was all transferred to individuals. That's what they're trying to do. And then aggregate it. Now, in fairness, like there are some people who have like hundreds of properties and they each have them in different trusts and companies. And they pay like no land tax despite having tens of millions of dollars worth of properties.
Legally.
Yeah. But the thing is if you said I want to introduce an anti-avoidance provision to attack that, that's not hard. Like you could create a technical anti-avoidance provision, and there's been dozens of technical anti-avoidance provisions over the last 20 years, 30 years for land tax, and no one kicks up a stink. People go, oh, this is going to increase, there's a bit of problems, they restructure, that's fine. You catch out the people who, there's always going to be people who are pushing the boundaries. And it's important that we have our tax legislation to nix that. That's fine. But nix that. Don't introduce essentially a new tax on people who have gone, I'm purchasing a couple of properties and this is the tax rate that I'm going to purchase them at. If you have 100 properties, I'm like, okay. In fact, if you have 100 properties and if you're paying nothing, well, you're going to be worse off. If there is some kind of aggregation, like I said, if you've got a shopping center, you're laughing. The big guys come out of this well, and it's the aspirational developers or property owners who are really hit hard. I mean, and we can see this clearly with the discretionary trust. So with a discretionary trust, which is the default structuring option for someone who has their perhaps first or second property, because you're going to want to stream income for federal tax. If you make capital gains, you're going to want to stream that amongst your beneficiaries. Even if you've just got one person, you're still going to likely put it in a discretionary property in a discretionary trust for asset protection. If they're a director of a company or they're a professional. And then you go, well, I'm going to use this for succession planning. I might put, a different property in a different trust. I've got, I have 3 trusts and 3 children. Line them all up like that. And then, maybe 5, 6 down on the considerations is land tax. And I can tell you that it's not high on the consideration list, because as a lawyer that does a lot of work in land tax, I see a lot of people who go, oh, they haven't structured their properties well, or they're getting, big tax bills and say, can you fix this? So your this isn't some kind of avoidance strategy. It's this is how you structure for the rest of the asset protection and income tax and CGT 101. But so here's how the new structures work. So for a discretionary trust, a discretionary trust is defined as something that is something that vests the whole or any part of the trust, and that vesting is to be determined by identity or quantum at some later date. It hasn't been determined, or it will occur if discretion is not exercised. So therefore, any trust where you have flexibility over choosing between the beneficiaries, even if you had a unit trust that has A-class units and B-class units and you can distribute between them, that hits the definition of a discretionary trust. If you could, amend a unit trust and, or make some choice in there that causes it not to vest on a particular person, that will fall under the definition of discretionary trust. Even if you have some kind of trust power, that will be a discretionary trust. It's immensely wide. Now, I think that if something meets the definition of a unit trust and a discretionary trust, you have the ability to just go to make a choice as to how you nominate it. But it's not.
Is that year by year?
With a discretionary trust, you get one nomination before 30th of June 2020.
And that'll remain for the...
That's it. So that remains. So in fact, it has to be a pre-existing trust and land for the introduction of the bill. So if someone comes to you today and says, I'm settling tomorrow, you can buy in a discretionary trust as the bill is worded now. So I just want to put in a few caveats there, because obviously the wording of the bill could change. It seems like they've said it's going to be this way from the time they introduce it into Parliament. So on that lucky day when Rob Lucas walks into Parliament and tables it, from that moment, discretionary trusts that are used to purchase property or land purchased in existing discretionary trusts anew will not be able to be nominated. So if I have property that's in a discretionary trust that I've had for 20 years, or I purchase it today in a discretionary trust, I have until 30th of June 2020 to make a nomination to Revenue SA as to who the beneficiaries, the beneficiary singular is. If I don't, it will be taxed at the higher trust rate. If I do make a nomination, then that beneficiary will be assessed on the entire value of the property, of the land in the trust, as if they owned it themselves, using this nice two-tier mechanism.
So if you had 10 trusts, nominate the same beneficiary,
yep,
you pay multiple on 10 properties.
Correct. Or you could pick and you could say, I've got 10 trusts and I've got 5 children, and I'm going to nominate 2 trusts for each of those children. Now, this comes then into a number of other issues. Like what happens if your children want to go off and purchase property of their own, and suddenly they've had this property nominated for it? Now, you can revoke the nomination, but once you've revoked it, it's done. It's always going to be taxed at the at the higher trust rate.
So you can't substitute at any point.
The only time you can substitute is if they die.
It's a pretty good opportunity.
Yeah. So if they die, then you can nominate someone else. You can't nominate, like if you get divorced or you're bankrupt.
What about testamentary trusts? The same rules will apply for them?
There's a nomination, you have to they're separate to discretionary trusts. There is a look through for them. You have a year to make an administration. You need to give notice. And then there are a look through to who the beneficiaries are.
So if you nominate the discretionary trust, you nominate a beneficiary, but obviously for land tax purposes. How does that affect that trust in relation to distribution of other income across to that trust? It's just the ATO talk to the land taxer, or?
Well, no. So it doesn't create an equitable interest in them. Now, if there was one area where it would have an impact, and that would be in family law. But on the other hand, in family law, they've kind of ignored trusts and the general concept of trusts since the mid-80s. So basically the way the family law cases go and the Family Law Acts just says, if there is a trust, we're just going to lob it in with all your other assets. Doesn't matter who actually owns it by. And it's long before Kennan and Spry. There's plenty of 80s cases that they ignored trusts as an asset protection vehicle from there. Then if we looked at, say, bankruptcy proceedings, the only one you might look at is, say, Richstar, which was a single decision by a Western Australian judge, later went to the High Court, but there's not really been followed, and it's got a high watermark, and it said, if you're the trustee, the sole beneficiary, the main beneficiary, and the appointor, and you're going bankrupt, I'm going to treat you as if you own this property. But that was for a very particular Corporations Act principle, but that really hasn't been followed. So in which case, I don't think that this notional deeming is going to have an asset protection problem in of itself. I don't think it's going to be picked up by trustees in bankruptcy. What it will have is other effects. So you nominate, there's say 2 trusts. One nominates the husband, one nominates the wife. They get divorced, and say the wife keeps both the trusts, and the husband takes other property in their property settlements. The wife, now the ex-wife, can't revoke that, or she can revoke the nomination for her ex-husband. She doesn't have to. It's under her control, and if she does, it's going to affect the land tax that she pays going forwards. So, and there isn't really a way of changing that nomination. So it's not an interest that can be traded, but there isn't much you can deal with it. It is, they're not intending this to create a bunch of useful trusts that pre-introduction of this bill that people can then deal with. It's kind of designed to be grandfathered and fall over at some stage in the future when people die or divorce or go bankrupt or transfer, if you can't transfer it to your children, unless you die. So
sorry, just one step back.
Sure.
Just a basic question. So if A and B own 3 properties and your land tax bill, we say $10,000.
Yep.
Would they be given one bill in name of A and B for $10,000, or does A get a bill for 5 and B gets a bill for $5,000?
So I don't know how they're going to administratively do this. The way the legislation sets out is that they're going to give a bill to A and B jointly for $10,000. They must pay this, and then B will get a credit for $10,000 for $5,000, and A will get a credit for $5,000.
On the other properties.
Yes, because they get taxed at 2 levels. Well, no, a credit, not a refund. So,
You guys must do crystal meth when I write. A couple of bloody uni students got this stuff together or what?
look, it's not fantastically drafted, to put it mildly. Well, actually, here's what they've done, is they've copied and pasted it from Victoria, but then put in their own little pieces. And you know, they haven't thought this through. They haven't, I don't, like, it says that it's supposed to fix an anti-avoidance problems. That's not what this does. It's basically a new taxing regime that imposes a fresh tax on a bunch of people on an asset class that is difficult to transfer.
Adrian, just back to when you're talking about the husband and wife in the divorce scenario. So the husband, therefore, if the wife doesn't remove her nomination for the husband on the property that she gets in the settlement from the divorce, he'll still be liable for land tax on that property.
Yep. He'll be assessed as if he's the owner of it.
He's no longer the owner of the property.
Yeah.
So then that will cause problems, won't it?
Yep, it'll definitely cause problems.
Have he not removed his name as a beneficiary and taken the, say, the court order and say, hey?
Well, no, so their family lawyers will have to think of that ahead of time.
The property settlement then.
Yeah, they'll have to do it.
Be offsets for that.
Yeah, they have to either like do offsets of property settlements. They'll have to think through their land tax planning. You know, family lawyers, like, that's not necessarily, like, tax is not necessarily their forte.
Nothing's their fault.
So, I've looked, you know, they're dealing with people, you know, like I'm a tax lawyer, I'm a back office person, I'm not a people person. So, you know, I like to put, you know, give credit where it's due. You know, I couldn't deal with someone crying on me, you know, all day. I'd say, well, here's some tax for you. So now you've got something to cry about. That was my first and last family law client. So, so other trusts. So, because it wasn't complex enough, they wanted to set if you as a beneficiary hold your beneficial interest on a further trust, you're called a beneficiary / trustee. And then so your interest will be aggregated with, will be treated as if it's the sole interest that you own, because that's how trustees are assessed, as if it's the sole property that you own as trustee, and then you'll be taxed on it at that rate, but then it will be passed on to the lower beneficiaries. And so it could go down a few tiers. The thing that I find interesting about this is that this is really the only way of carving out a part of a nomination. So if you have a discretionary trust, just say it has 5 properties, you can't make 5 different nominations, one for each property. So say you have 5 children, 5 properties, but it's all in one trust. You can make one nomination down to a single beneficiary, and they will be assessed as if they owned all 5 of those. But using this beneficiary trustee, if you nominated one person, but then that one person says, I'm going to hold any interest that I have on a further trust for 5, like for each of these, in 20% holdings, then you could split it up that way, potentially. You could definitely do it with a fixed or unit trust. You can work out what a unit trust is. You might be able to do it with a discretionary trust. Now, I flagged before that I've defined what an excluded trust is. So charitable trusts, concessional trusts, public unit trusts, super funds, and limited recourse borrowing arrangements. So when you're buying a super fund and you set up a bare trust, that borrows and holds the property on trust until the borrowing has been repaid. Those are excluded trusts and they are taxed at the standard rate.
What about special disability trust?
Yes, special disability. There was a few others, and so I didn't list them all. So an implied or constructive trust is deemed, the trustee is deemed to be an owner, and you taxed at the trust rate only, with no ability to make a nomination. And this is entirely separate from all the other nomination rules. So let's say you have provided the funds for purchasing a property, but the property is purchased in someone else's name. Really classic implied trust example. And so they're holding it as trustee for you. They need to give a nomination, they need to give a notice to Revenue SA about this. Now the fun part is that often implied or constructive trusts, people aren't aware of them. Or a constructive trust, another common example is the farmer who says to his sons, "You've got to work on my property for 40 years and I'll give it to you." And then one of them has worked 40 years and leaves for the city, and the farmer says, "Well, no, you're cut out. You're not getting anything." And he says, "Well, no, I've just done 40 years of working for nominal wages. I have some entitlement here." So in that case, the farmer would have to realize what this constructive trust and give a nomination. Similarly, if you're the vendor after completion of a sale of property, but before the title is registered, so classic constructive trusts that arise upon the sale, aren't they a trustee? Doesn't this mean on every sale and purchase that you need to make a nomination, like where there's some, like a time between completing it, so paying the money and the final registration of the title? Now maybe if we're all doing electronic lodgements on PEXA, then this won't arise. Good plug for PEXA there. Not going well. That was funny. But if you're doing a classical registration, a paper-based transfer, and the money is paid or all the things have completed, and the vendor is but hasn't transferred the title over, there's a constructive trust there. Theoretically, you've got to give notice. Resulting trusts don't seem to be covered or considered. So resulting trust, someone, for example, settles a property, settles some money incorrectly, says, "I'm going to hold this money on trust for someone," and it fails, or hold this property on trust for someone. It fails, and it comes back to them as a resulting trust. And so the first person is holding it as a resulting trustee for them. I don't know. Again, this is these are edge cases, but sort of shows that they've had the stabs at various ideas, but haven't really covered the field. Okay.
Just one thing else.
Sure.
How's all this going to be worked out? Who's going to tell Revenue SA?
Oh, we've got a notification slide. That's the next one.
And just another question.
Yeah.
So where there's a commercial property structure where there are units issued to various companies and individual purchasers for, say, multi-million-dollar commercial properties where you actually hold units. So you're not registered as a company, you're registered as a trust structure under that presumably. So
you need to give nominations at each of the unit holder levels. So the trustee has an obligation. I might just skip to the next slide, and then I'll come back to principal place of residence. So you may nominate, if you're a fixed or unit trust, you may nominate the beneficiaries. If you don't, then you're going to pay the trust rate. If you have a discretionary trust, you may nominate, you can choose not to, before 30th of June 2020. And if you do, then if the trust was in and owned property before the introduction of the bill, then that property and that trust will be deemed to be owned by the person nominated. Those are the may, but then you've got a whole bunch of musts, and this is going to be a nightmare. And I'm sorry, guys, you're the ones who are going to have to deal with this. This is the conveyancing nightmare. So you've got to make you must lodge the following within 1 month. If you become a trustee, if you are a trustee when the legislation commences, so you need to go through all of your books and find everyone who is a trustee and make a nomination. If the trustee disposes of land, in sum or in part, if you acquire further land, you buy something else, if you change the type of the trust. Now, I'm not sure if that means you make any kind of amendment to the trust, or whether you make, if you're amending a trust and it appears to be fixed, and then this may be considered to make it discretionary trust. Who determines whether you've changed the type of the trust? But if you do change the type of the trust, whatever that means, you have to make a nomination. If it's a fixed or unit trust and you change the beneficial interest of the unit, so every time there's a change in the unit holding, that needs to go. And if you're completing the administration of a deceased estate. Now, this, I hate this kind of nomination stuff, but I did think of some fun. So the lowest property the cheapest property on sale at the moment, it's about $30,000. It's like a little derelict church up near Penola. I looked on realestate.com. So what you could do is you could get a number of people to crowdsource the purchase of that for a very small amount of money, $100 each. It's not going to cost much. And then so we put it on a unit trust that is owned for them. And then we either have the unit trust register, I'll just put it on a website, and so you can buy and sell these, or you could have some fun and put it on a blockchain or something. I build legal tech for a living, so, but let's just say that you could easily transfer this. And then we follow these rules exactly. Every time there is a change in the unit holding, we send like a faxed letter or something to Revenue Estate. And then we say go for it. Invite everyone to buy and sell this as many times as possible. Every day you get like 50 or 100 nominations faxed in. So that's my fun. That's a hypothetical. If someone, I would not encourage someone to do that, because that would be problematic. But why don't we just think about it as fun? But practically, this is going to be a real pain for someone with a large unit holding, or when there's something that's broadly held, or you've just got you've got a big corporate group that's just got a lot of interests, and it's really easy to change interests in a group.
That's a question.
Sure.
In relation to deceased estates, so assumably on the date of death, the executor.
I don't think they have to give notice. But they do have to give notice once it's administered, and I think they have a year to administer it, that they've got a year. And there's a deemed look-through, so it ignores the Livingston case of, so the Livingston said you don't have a beneficial interest until it's sufficiently administered. It says you're deemed to be administered, I think that's how it works. Don't hold me to it. Is that after a year you're deemed to be holding it, and then after that time, if no one has a beneficial interest, then it'll be taxed at the trust rate. I think I've got the legislation there.
Okay.
Sorry?
Well, okay, but assuming it's a difficult estate, it might not be administered in a year. So at which point, after that, land tax becomes applicable to the
Trust.
at the rate of the executor.
Yep.
Okay.
Yeah, at the trust surcharge rate. That's my reading of it. I was looking at that specific point because I was like, this is the executor stuff. That's everyone just really wants to know that. I was like, I'm not 100% that I've got the answer right. It's just a mess to read. I'm sorry.
Can you just go back to your comment about, sorry guys, it's up to you. You've got to do the notification.
Yes.
addressing, obviously, conveyances.
Yes.
Why do the conveyances? It's
Oh, I-
for the taxpayer.
Well, the taxpayer has to do it. Yeah. The thing is, so practically what's going to happen is the taxpayer is going to say, oh, you're looking after my tax affairs or my property affairs. You know, but like maybe they'll yell at their accountants. Yeah, accountants. It's accountants. Yeah.
So the legislation doesn't specify whose obligation
No,
or
it
whether taxpayer.
doesn't. You just dodged the ball there, didn't you? Right, so, principal place of residence. So you can have the unit holders or the fixed beneficiaries or the fixed or unit trust claim the property that's the subject of that trust as their principal place of residence, but all of the unit holders must live there. So if you had This is not a land tax. This is not a tax seminar. This is just like some kind of comedy skit. like I've never had people laugh so much at tax, but kind of in this like painful laugh. Like, this is. So they've just carved out this really narrow use case of, you know, mum and dad buy their residential property in a unit trust and then own all the units themselves. For what godforsaken reason, I cannot think of. Because what's the benefit of that? You've just got to own it in your own name. There's no tax benefits, there's no CGT, there's no asset protection. Now maybe if you had like different units across, you know, in different places, maybe. And in fact, at the end, I've got to make some suggestions on structuring. How long have I got? I got 10 minutes or half an hour? Cool. So we can nominate. So we can nominate a discretionary trust beneficiary to, if we say that this is their property, then they can be their principal place of residence. It seems to me that it isn't actually. This is another one of these provisions that I'm not really confident on this one. But that's the best reading that I've got over there. So if you have a discretionary trust and it has someone's principal place of residence in there, if you nominate that person who lives in there, then they can get the principal place of residence exemption. But it's much less built out as a provision than the principal place of residence exemption for the unit trust holdings and fixed trust holdings. This doesn't apply, principal place of residence exemption doesn't apply to a beneficiary trustee, which again, it seems to be weird considering that a trust, my reading is that a trustee can have land as their principal place of residence. So if you were, say, the trustee of a discretionary trust and you owned Blackacre, but you also lived there, it seems to me that you can claim that as your principal place of residence, as you can at present. And this is the instance where the minority interest provisions are really designed to kick in. So at present, you could be the trustee of say 5% of property or 10% of property. And so long as you are on the title, you have a legal interest, you're counted as being the owner, it can be your principal place of residence. But here, if you just have a small interest in it, that will be ignored. So the minority interest provisions cut out the cases of like Calmel and your Theo Morris's case that we dealt with the principal place of residence exemptions where they either distributed like 5 or 10% of the property down from the trust to the beneficiaries, they own that, or transferred or made a change of trustee for a small piece. And the reason why you might do that for just a small piece is because you say, well, this is an individual, we don't want to put the whole property at risk. So if you do want to make someone a trustee, you now have to put the whole property in some ways at risk by virtue of them being on the title. I mean, they are a trustee, so it is isolated from their other property, but still, it's still not good. So, on to corporations. So companies are grouped, and they're grouped into one conglomeration of taxpayers. And they're done so if they're related or there are controlling interests. Now, they're going to be related if you can control the board, as if one company can control the board of another, or if there are more than 50, or it has more than 50% of the votes or 50% of the shares. Similarly, there is a controlling interest if a person or persons together can do the above. And so if you have, so you can look through various controlling interests, and you might say these two companies together control a third one, and in that way, corporate groups can be expanded. Now, they'll also look to relatives. So if a person and their associates can do so, then that'll be picked up as well. So the companies that aren't going to be grouped together are companies that have disparate shareholders. Unfortunately, there aren't really good degrouping provisions. So in the Payroll Tax Act, companies can get grouped together, and if that's wrong, there is some mechanism by which you can apply to the commissioner and say, I wish for you to degroup these for whatever reasons. And here there isn't a mechanism for that. Presumably the idea is that it'll be done ex gratia or something, but it's not in the legislation. You shouldn't trust things that are not in writing. That's why we have the statute of frauds. Applies to politicians as well. Now when you're calculating this controlling interest, the share capital doesn't include fixed returns such as debentures, and so so certain preference shares won't be picked up. Certain debt instruments wouldn't pick up your simple agreement for fixed equities, your safe notes. So lots of different types of corporate instruments. So you could have, but you could conceivably play around with the shareholdings to change the grouping of this. There isn't a notification provision in here, which is a little bit weird. But presumably they're going to look at ASIC and say whatever the shareholding is, that's it. So, but what happens if it's beneficially held? There isn't a requirement to give a notification as to who the beneficiaries are. Now, what happens if the shares are if you give someone nominee voting rights, you don't have to disclose that. So, there is weird. It's quite. It's not uncommon for people to give their voting rights to someone else. Now, does that mean that if we've got a bunch of patsies out there to own shares, and we say you're going to hold them beneficially for me and and nominate the voting rights, it's not the companies are not going to be aggregated with other companies? I'm sure. Also disregarded is a financier with security interests. So if a financier has, say, a bank has the voting rights or capital rights or control of a board by reason of their lending, that's not going to be aggregated. So and so banks won't accidentally group together companies. But if a group is, if companies are grouped, then the commissioner has discretion as to how to assess them. Could assess them jointly, or separately, or pick amongst them which ones the commissioner is going to assess. So, like, I expect that the commissioner will just fling assessments as to wherever he thinks the money is going to come from, wherever she thinks the money is going to come from, as a female commissioner. So, like, that doesn't, there isn't a principle that says the assessments should lie where the tax is. And companies can be grouped, even if they're not in South Australia. There's no jurisdictional restriction here. So you might end up grouping a South Australian company with some Queensland company, and then by virtue of that grouping, deem some other company in there.
Is it de facto way of taxing land out of the jurisdiction?
Yeah, well, I think it's more that you'll pick up assets outside of the jurisdiction, like in regards to being able to make assessments on assets outside of the jurisdiction. You're not going to assess land outside of the jurisdiction. If there's Queensland land, you're not going to be taxed on that because you're only taxed on the amount of South Australian land. But it's more a case of if you had South Australian land and the commissioner put a charge on it, and the South Australian land is mortgaged to the hilt, but you happen to have a related company, or in Queensland, and he says, well, since you're related, I'm going to assess you jointly and separately. Out you go.
Like it's the creation of the liability rather than the
Correct.
charge.
Yes. So, structuring thoughts. So, first of all, so there is a fixed time frame to make discretionary trust nominations. You have until 30th of June 2020. Everyone who owns property in a trust in South Australia needs to take consideration of this structuring of that property between now and then. I can tell you May and June is going to be very busy. So, but when you're making this nomination, this isn't just, I've got 3 kids, I'm going to make 3 nominations, for, like one nomination for each of them and one for the husband and wife. No, but you have to think about your asset protection. Like, so what happens if you're making nominations, and what happens if you're bankrupt or you're considering divorce, and like you need to think about that. What happens about your estate planning? So if you're nominating Blackacre to child 1 and Greenacre to child 2, it turns out you leave Greenacre to child 1 and Blackacre to child 2, you're going to cause problems. You can't change those nominations. So you're going to need to think through what properties are going to what children. Think through, like, are you going to dispose of these? Calculate the fairness in tax going forwards and say, this, I'm going to give Blackacre to child 1, and therefore I'm going to nominate them. You have to make these decisions between now and 30th of June 2020. If you're going to leave property to someone, like as the everyone's planning for their succession, everyone's getting grayer hair. Like I've got gray hair. You need to think, like, if I nominate Nana, like what happens if she passes away? Who's going to be the next person in there?
Sorry, can we just go back to this nomination issue?
Sure.
I nominate my child for a property.
Yep. So for a discretionary trust.
Yep. Discretionary trust. And then I sell the property. What happens to the nomination? Does it die?
There is a nomination for that trust. It's not for the property, it's for that trust. And it's for that trust, and only for property that trust owned before the introduction of the bill into Parliament, before the prescribed date. So if you buy a later property, it's carved out and taxed at the higher rate.
So you can't nominate for that other property?
No, that's it. So it's
one's a state tax and one's a federal tax.
No.
What Nick's saying.
No, this doesn't nominate. This doesn't create a fixed interest in any way. So what you could do is you have your discretionary trust, and you nominate your child 1 for this trust, and then you distribute all of the income and capital from it to child 2, or to your wife, or to someone else.
We're only talking about land tax.
We're only talking about land tax. But so for land tax, once, like, if you buy further property in that trust, so after the prescribed day being when they introduce this into Parliament, that tax, that property will not be subject to the nomination. So if I have a discretionary trust now and I have Blackacre as of today, and I nominate myself as the beneficiary, in 6 months' time, I purchase Greenacre, too late. Like, it carves out. Greenacre gets taxed at the higher tax rate, Blackacre doesn't. So it's only property that you hold in trust as of when they introduce this bill. Any property that you purchase after that in a discretionary trust, it doesn't matter if there's nomination or not.
Pay the surcharge.
It's going to pay the surcharge, correct.
So I understood Nick's question to be that they sell the property, you sell the property.
Yep.
So the trust then all of a sudden has got no property.
Correct. Yes.
Then the trust, which goes on in perpetuity,
Yes.
buys another property.
Yes.
Do you get the opportunity to change the nomination then?
No.
That's stupid, isn't it?
Yes. So you can't. So because
Isn't that what you're asking?
yeah. Yeah.
You don't pay land tax on the property you sold, obviously.
No.
No.
But on the new property,
Provided that you sell it before 30th of June 2020.
No. Well, that's the problem. I own this building.
Yep.
It's in a trust, discretionary trust. You are my child.
Yep.
I nominate you.
Yep.
Right? In 3 years' time, I sell this property.
Yep.
What happens to my nomination for that trust that continues?
No.
It's got other properties.
It continues for the other properties. That's fine. Because you're making the nomination at the trust level. So all of the properties in that trust,
As at
As
the June.
as of 30th of June 2020, are nominated for me, the child. Now, if you sell those properties, sure, that just reduces the net value of those properties. If you buy an additional property, though, that's not subject to the nomination.
So all you're doing by nominating is saving the church surcharge.
Correct. Yep, saving the surcharge for the properties that you own as of the prescribed date.
Do we have any idea of this prescribed date?
The prescribed date is when they introduce it, and so what they've done is a couple of weeks ago they finished their consultation, and so they everyone made submissions by then. Now, from what I've heard, is that they're going to want to bring the legislation in as quickly as possible because they correctly acknowledge that this is causing disruption in the market. Basically, people go, well, what do I purchase it in? You know, if someone's like, I have literally had clients come to me and say, I want to purchase property, and I say, if you can delay this, you should. If you have to, like, we're just going to make the best with what we're doing. But if you can delay the purchase, then go. You know, or if you can purchase in, you know, not South Australia, do that. So another thing, so people start off going, okay, cool, I've got husband and wife and 3 kids, cool, that's 5 people. But then you go, that's 5 people I can nominate. But what happens with the children's future purchases? So if you're nominating your children and then they go, oh, wait a second, I was about to purchase property myself. You know, so if you're going to be making nominations on behalf of a broader family group, you actually need to have the difficult discussion and bring them in.
And you can only have a single nomination, is that correct?
For each trust.
For each, and if there's a trust which has 5 beneficiaries, it can only be one of those people, even if you've got 6 properties.
Correct. Yep.
But somehow one's going to get lumbered with the lot.
Correct. Correct. One's going to get lumbered with the lot. I mean, we wanted to do a really quick trust split and or transfer them out. Probably segregate it. Like if you had something that was really urgent and you said I want to do that, probably be effective between now and the introduction of this, and then so you could split that trust into say 5 trusts, but noting that things like so trust splitting where you take one trust and you carve it into multiple trusts. So if you have a starfish, and if you cut a starfish down the middle, both sides will regrow the remainder of the starfish. So you have 2 starfish, both of which are the original. No starfish were harmed in the making of this example.
Can you still split trusts?
Yes. The ATO in TD 2012 D3 says, we don't think so, but they've pickled themselves. Because on their reasoning, in my view, is that if you appoint a new trustee, that is resettling a trust. Therefore, every appointment of a new trustee is a resettlement, and there isn't any way around that. That's my view, so they've taken the new trust view, as it's called. I might refer you to Dr. Campbell Rankin's PhD.
You would want to do that, you'd be here all day.
So I'm a Campbell prodigy, one of his longest lasting lackeys. Acknowledge Campbell as pushing that idea, and then the ATO have taken that. That's what I read them, and I've said, you've got some trouble there. There's been a lot of other people who have really disliked the idea that the ATO wants to get rid of trust splitting, and there's been some very forceful opinions put back against it. They're stuck it with a draft ruling. So probably the short answer is that you probably can't do trust splitting, but there are possibly some ways that you might, but it's all a big mess because the ATOs, they're half pregnant. They've said kind of no in draft, but not finalized it. But even if you did do that, you could pretend that's only a CGT thing, so you might say, oh, I can find some rollovers. So you might say, I want to split my one trust into, say, 5, either find some CGT rollovers or, run the gauntlet with the ATO, or thinking that we can split it in a way that doesn't meet what they call is a trust split, and which I do think is possible. And in which case you could separate one trust into 5, have 5 different properties for the purposes of flame tax, and therefore split it out for multiple different children. And you're going to need to do that before the introduction of the bill. Or have,
So you save on land tax, you spend on solicitors.
yeah, lawyers are bastards.
No disrespect.
Yeah, well, they say 95% of lawyers keep the rest of their name. Yes.
Can you clarify, in that situation where you've nominated a beneficiary under a discretionary trust, how it's proposed to be taxed, so how it's to be charged? So the trust gets charged?
Yep.
Is there a credit?
Yes, there is a credit for the beneficiary. And so the trust will be charged at the standard rate, and then the beneficiary will get a rebate at that amount that's been taxed for.
So moving forward, for those that are not nominated for new purchases, same aspect, so the beneficiaries of those trusts will get a credit on the.
Well, there isn't a beneficiary nominated, so no, the trustee will just pay the tax at the surcharge rate.
Yep.
And I'm actually going to suggest that might not be a terrible idea. So
with a corporate entity trustee for a self-managed superannuation fund, that's an extent. So then you just get charged the standard.
Yep, for a super fund, you're going to get charged at the standard rate. So in fact, I'm just going to skip to the next slide. And so super funds are at the standard rate. So one thing that you might do if you're purchasing property going forwards, you might have a number of different super funds.
Yeah.
Now, of course, then your accountants are going to love you because there's just all these auto fees. But if you've got an accountant who gives to say, hey, look, all these super funds are identical. Let's charge you a discount rate. So you could be fine. You're going to pay. You have so long as you've got the money in there, or you can get limited recourse borrowing arrangements in place to be able to do that. You purchase each of your properties. You can have $450,000 worth of property in each super fund. You have 10 super funds. You got $4.5 million worth of property and no tax.
They'll be taxed for land tax separately.
They'll be taxed, yes, at the low rate. So without the trust surcharge. So the trust surcharge, and if we go back to my first slides, was here. There's a 5% surcharge, and as opposed to whereas a super fund will be taxed at a $450,000 tax-free threshold. And at present,
Yeah, but if the 10 super funds are all owned by, at the end of the day, the same entity.
no, they don't, like, so at present in our aggregation rules, it will often matter if if it has the same trustee. But from now on, it doesn't. All of those aggregation rules,
Don't apply to.
yep, they're all gone. So this was slide number 4. Existing aggregation rules to be repealed. So at the moment, when you're setting up trusts, you will by default have a different trustee for each trust, because then prima facie they will assess them differently. You no longer have to do that. If you own multiple pieces of property, have one trustee, 10 trusts. It doesn't matter. You have to give the notification that you hold it on trust, but you don't need to nominate who the beneficiaries are. And there aren't the mechanisms anymore to look at the trusts and say they seem to be the same discretionary trusts for the same beneficiaries. So therefore, they're all the same super funds. You could say this is the same super fund for the same beneficiary. So all of that mechanism is gone. So you don't need to have 10 corporate trustees.
Let me just go back to my 10 trusts example.
Sure, I could give you that exact example here.
All right.
10 trusts.
No nomination.
Yep.
So you pay the 0.5% surcharge.
Yep.
On each property owned by each trust.
Yes.
But there's no aggregation.
Correct.
Of all the trusts.
Cool. Can I wander through that exact example?
Because I'm just thinking it's worthwhile doing the maths.
I've done the maths.
I haven't done it yet.
Yeah. So I'm just gonna. Do you mind if I just finish off the structuring thoughts and then we'll go to the maths? So the next structuring thoughts is for unit trust. The thing that really concerns me from a structuring perspective is there isn't a great definition of this. I've said this before. The thing that I can say is that there isn't the provisions that they have in New South Wales that require it to be fixed, and it seems to me that you can nominate something as being of a particular type. Say you can say that it's a fixed trust or a unit trust or a discretionary trust. Now, what happens if a trust is a unit trust that also has some discretion in there? It seems that you can pick between the two. So, if you can, then this would be the suggested structure going forwards for new purchases, particularly on purchases with, in your first couple of properties. So you might have separate income and capital units. So you might have the income units going to one beneficiary and capital units to another. You might use, like I use this structure quite often to getting around to fixing up Division 7-8 issues. You subscribe for income units, and then they say company subscribes for income units, and then they create new capital units off to a trust that, and so then the capital gains go over that way. Or you might have corpus protection units. So you say that you have this, mum and dad buy a property in their name. They have the units in their name. Sorry, they purchase it in a unit trust. They have the units directly in their name, but just in case one of them goes bankrupt, there's provision in the unit trust saying that if you go bankrupt or get threatened with bankruptcy, then you will lose your interest. Or if you give some nomination to it, then you lose your interest. There are some, you've got to be careful when you're doing that, but there are some ATO rulings that set out the circumstances when you can create such a trust. So this is the way of getting a relatively simple structure that gives you those potentially federal tax things that you're looking for, asset protection, CGT, income tax, while also having a fixed or a unit trust that doesn't pay the land tax trust surcharge rate. So another thought, so you don't need to make a nomination. We've removed the aggregation provisions. Now, so You might then go, I'm going to purchase, like if I'm going to purchase 10 titles, I will buy each of those in one separate discretionary trust, and I'll show you the numbers, and it doesn't necessarily, can work out okay. So more than you pay now, but it can work out okay. Now, sure, they've got rid of the aggregation provisions, but there is one thing that I would caveat, is that the anti-avoidance provisions in Division 6A of the Tax Admin Act, I haven't seen them used for structures set up initially, because they've always used the anti-aggregation rules. But it might be the case that, particularly if you purchased 100 titles in 100 different trusts, that they would say that this is done for the purposes of anti-avoidance. So I wanted to just flag this. But if you are purchasing a reasonable number of different titles in a reasonable number of different trusts, or whatever reasonable means, then this is what you might do. So we have 10 properties, here's my example, of $250,000 land value each. Now, under the current rules, so it's $2.5 million. I'm going to take off the highest rate, 1.302. That leaves $1 million left at the highest rate of 3.7%, plus the threshold amount. So under current rates, you would have $57,569 tax. Okay. Now, if you had each of those 10 properties of $250,000 each in a separate title per discretionary trust, you would be paying nil. So if you have thought about this and you structure this correctly, you'd be paying no tax. If you've got it all in one, you're going to be paying $57,000. Now, at the rates that it seems to me that they're going to introduce them at. Again, we don't know exactly what the rates are, but based on the tables that I put out before, if all of the property is assessed to one taxpayer at the standard rate, so it's either owned by one person or it's owned by a discretionary trust and there's one person who's nominated, it's owned by a unit trust or fixed trust and there's one beneficiary who's nominated, then there would be $40,000 worth of tax. So that's lower than the maximum now. Now, if it was all aggregated at the trust rate, so it was all owned by a discretionary trust, it's going to be $46,000. Now, if you have one title per discretionary trust, and you make no nomination, you're going to pay about $12,000 tax. And if there are 2 titles per discretionary trust, and say you have 5 different beneficiaries, you've got a husband, wife, and 3 kids, then you're going to get $1,800 tax. So that's kind of your best case scenario. Now, then you might say, well, here's the summary of this. So under the current regime, if you can't separate out these titles, you're going to be paying $57,000. More realistically, you have got some kind of structuring thoughts going forwards. So someone has structured this well for you, you're probably paying well less than $57,000, more likely nil. If you're only having 10 properties, particularly if you purchase them one at a time, maybe you're paying a little bit because some of them are 250, some of them are 450, some of them are 700 or something, or there's a couple in one trust. So you might be paying more than that. But that's the range. So here at the standard rate, $40,000, at the aggregated trust rate, $46,000. If you purchase it, so if you can split properties into a number of small titles, you can do all right. Well, not all right, because $12,000, it's that's still a fair chunk of your returns. So just think, these are $250,000 properties, and you're paying. Where was it? You're paying about $1,300 land tax on each of them.
Recurring.
Every year, yeah. So that's a percentage point. Considering you're only making 4 or 5%, you've suddenly not making any money out of this anymore. You've maybe lost 20, 30%, 50% of your revenue.
But how would you go, like you've got new tax, one title per discretionary trust, but if you've already got these unit ownership in what, one trust or
Yes.
5 trusts? Because you're going to end up paying stamp duty to then.
Yeah, well, so this was just an example. So this is just like, so if you have this all currently in one trust, you've got 10 titles, $2.5 million in one trust. That's what you'd be paying every year. And this example came to me because I've dealt with a couple that are kind of similar to this, and people have been buying property, and like, I have to complete this purchase, and so I said, well, how much are they paying at the moment? They're paying a lot. Oh, right, because they're big corporate, they don't care. And then you go, well, you're a big corporate, you need to pay attention to this. So if they've got this all aggregated, most likely, if someone has a number of titles and they've owned it for a couple, some number of years, they would have wandered into their accountant or conveyancer or lawyer and said, "What are you doing? You're an idiot." They would have at least considered this. Or they would have been paying so much tax they would have sold them off. So this, the only person that would be paying $57,000 of tax on $2.5 million worth of property holdings is someone that has one single piece of property that they can't split up into pieces. So if they can split them into pieces, it is almost certain that they would have done so many years ago.
But even now, you would need to be careful, especially if you had properties that had CGT qualifications.
Absolutely, and so this is
seriously careful.
So now when you're playing around with this, you're going to need to think through not just how do we shuffle this around for land tax and stamp duty and CGT and income tax and asset protection and estate planning. Like, it's a whole kit and caboodle. Like the state government is putting a huge expense on taxpayers to be able to continue and not totally go under. So I've got 5 minutes. We've got any more questions?
Can you, sorry, explain that last one, where you've got the same property down to 1875?
Yeah, so let's just say instead of so we put each property in a separate trust, and then we have mum and dad and 3 kids, and each of those discretionary trusts. So 2 discretionary trusts make a nomination for each person. So 2 nominate for mum, 2 nominate for dad, 2 nominate for child 1, 2 for child 3, 2 for child 3, etc. Or that's what you'll get down to 1875.
All up the 10 properties.
All for the whole 10. So I mean that's not bad, but you're going to have to you need those 5 beneficiaries, and then you might say, well, wait a second, child 1 wants to buy a property, and so I'm going to screw them up, or these are all lumpy, or I can't transfer them out, or I've got 5 properties in one trust, and I can't nominate them out.
Yes. That bottom example, the discretionary trust and the properties need to be held now.
Correct. They need to be held now.
It's not something you can put in place.
No. So if you're purchasing in the next week, you can do this.
They're sitting next week, so we might not be able to do that.
Yeah. So maybe not. So hold your breath. So if you're settling this week, then you can be okay. If not, then you're stuck. In which case, the more likely. So this is really only for people who have, they've been planning already. They've got, one trust, one property per trust or a couple of properties per trust. And they say we're going to make it, and we've got a number of kids, or family members, or nana, or whatever, and we're gonna make nominations for them. You might get down to that. That's the sort of best case scenario. More realistically, I think going forwards, if you can break things up into multiple titles, you will go 12,000. One trust per title, or one title per trust. I always get this wrong way around.
One ownership per trust.
Yes, one fee simple per trust. And then you don't make a nomination. So then it's not aggregated with anything else. So so you pay $12.50 per property, say in this example, but that's kind of the best you can do. So it actually turns out that the surcharge isn't necessarily the worst thing to call. The ones that's really going to be bad are when you have like a corporate group, because it's really hard to restructure companies without triggering a bunch of nasty tax. The ownership, it's just as it is in ASIC, and there's, everything's aggregated. There's no ability to choose beneficiaries or not. It's just banned. It's one corporate group, you're in trouble. So if you're, developers and you're particularly holding property as trading stock, you're in trouble. And so for all you people who are going, I'm going to start my first development, to divide this into a few pieces, a few titles. So it's, it's just not economical anymore.
Is it fair to say that those that have purchased property over the years and purchased one property per trust, this is just to do with this, today are probably going to be better off with this legislation?
One property
owned by a trust, property two by separate trusts.
Yeah. Will they be better off?
They're not going to be aggregated.
They're not going to be better off compared to other people, or better off compared to where they were before?
No, they're going to be no worse off really under this new legislation because there's no aggregation.
No, well they'll go from nil to 1875, and that's kind of the best case scenario. More realistically, they'll go from nil to 12.5 grand. So they'll, depending on how many people they could nominate, it'll be somewhere in between there. So they're definitely worse off, but they're less worse off than $40,000. So if they haven't structured like that, they're going to be worse off. Like they're going to be really badly off. If they have structured one property per trust, then they're going to be less worse off.
Land used exclusively for primary production is still exempt?
I think so. I didn't see anything change.
I haven't seen it.
Yes, I didn't see.
You as the expert now.
Oh God, that's a heavy handle. Yeah, I
would assume that
changes.
It's still exempt.
Yeah, I think that's it. Oh, one more.
Is the aggregation rule, the new one, is that going to capture people that say you've got a trust that owns properties, but that trust is also in partnership with two other parties on another side?
So you've got a trust that owns property, but the trust is acting in partnership with others. When you're saying it's acting in partnership, is it a registered proprietor, or is it?
Yes.
Yeah, it would be picked up. Yeah, you're going to go into your joint ownership rules. So you're going to go joint ownership level, then trust level, then beneficiary levels. That's why I said you get multiple levels.
Can I just ask one final question? Sorry. In this notification, which is quite concerning, if you fail to disclose to Revenue SA, and they eventually come back and make inquiries, they do audits or whatever, and they find out that you should have disclosed information that would have created a tax liability, be caught by the anti-void commissions.
There'll be penalties, yeah. Sure. And they'll now I'm not sure if there's there won't be penalties on the conveyance, so there'll be penalties on the tax. I think that's it.
So will there be a formal announcement? That's
I'm sure it'll be in the news really soon. If they're sitting next week, maybe next week's our week.
So then we start to disclose the.
Oh yes. So what will happen? So going forward is they will introduce this into Parliament. It'll get debated. It'll either get shot down or it'll go through. And if it goes through and then it passes, we should know before the end of the year what's happening. This is how people are going to be taxed. And what notifications are going to have to happen.
And the argument would be, it'd be simpler just to put a lower rate of land tax on every property.
Yeah, I mean, what they've done is they've, under the guise of an anti-avoidance provision, they've just slugged a massive new tax regime on property holders. They should have done this, in my view, if they're going to do something broad like this, that they should have gone, let's do a full rethink. Let's consult. Let's look at doing something broader or grandfathering or, yeah. But like it's terrible. It's just not good. It's not good tax administration. Everyone needs to pay tax. We need it. We need it for our schools, our public hospitals, our roads, and everything. We need to collect it. But what really matters is that it's administered in an efficient way. The people aren't penalised retrospectively for decisions that they are encouraged to make. That when things are made, they are made prospectively, saying that this is what's going to happen. You're in the future going to be taxed in this way, so that you can make reliable economic decisions going forwards. Morons. Yeah.
I missed the first 10 minutes. I'm really sorry if you've already answered this question.
Sure.
But if you have, and this is not anything to do with trust, this is to do with mum and dad. So mum and dad own a property jointly, and they own, mum owns one, dad owns another one. So A and B, A, B. And they all perhaps A and B, they pay land tax in this one here, and there's no land tax payable here or over there.
Yep.
Are they going to look at those collectively? And
if you're owning them jointly, it'll bring them together as one taxpayer.
So A will pay for his one in his own right and half of A and B.
Yeah, so it's going to be assessed at two levels. So first of all, you're going to be assessed jointly with all other properties that you own jointly. Yeah. So if A and B own properties together, they're going to be assessed as a joint taxpayer.
Yeah.
And then they're going to have their notional interest, say 50% each, brought down to them, and they will be assessed on that 50% interest, aggregated with all other property they have. But they will get a rebate on the amount of tax that was paid at the joint ownership level. So they could pay more tax because perhaps it's aggregated with other property they have, but not less tax than that. There's no opportunity to get a refund.
So that would probably mean the single holding rate will increase. We'll see more of that on more properties, won't we? They're going to assess them all that way. We're going to have more single holdings to adjust the settlement.
Yeah. No, the threshold's going to increase, isn't it?
Yes.
So,
okay.
If you'd like, I'll be around for a bit, answer any further questions. Thank you, guys.
Thank you.